Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I will be your host. So today, I'm here once again with my friend Doug Heagren. Hey, Doug.
Good morning, Kirk. How you doing?
Doing well, doing well. So we're back at it again. We've got a whole bunch of brand new news to talk about. I wanted to start off with this one little picture, which I think it's humorous, but I think it'll prove the point. And if you see it here, if you're not on YouTube, I'll try to explain it quickly. But those of you who are not on YouTube, please go. And by the way, those of you who have realized that we're not up there for every YouTube video, we're not gaslighting you. We're just working with new editors, and we're trying to get it all worked out. So we're not forgetting about you. Just know that they are coming, and they're a little bit delayed. So yeah. So anyway, so there's a picture here which I thought was brilliant, which is one was from Fox News saying breaking news: inflation soars 8.3% in August versus last year. Right below it, Wall Street Journal: breaking news: U.S. inflation eases to 8.3% in August as gasoline prices cooled. So you have the same number, and you have two completely different perspectives from the news source, or at least how they think you should read it. You should read it either, oh my God, there's so much inflation, or hey, inflation's easing, you should feel better. Well, which one is correct? I don't know, but certainly I'm not going to take their opinion of it because they're not any smarter than anyone else is in terms of where inflation's going in the future. So I think it's just a lesson for all of you that, the media is, they are tilting you in one way or the other, whether you realize it or not. And I think that is a perfect image of that. And it's not even from both sides of the political aisle. It's just two completely separate sources, both of which you could argue are on the conservative side. So, just something to take with you is that you should be seeing that pretty much in all media. And, one of the things we try to have you focus on the show is think for yourself, right? Don't let other people think for you. So moving on to more important topics. So Doug, one of the things we've started to see, and we were talking before the show, and so I really want to let you kind of run with this, but we've been seeing food inflation for a while, and people have been calling it shrinkflation. There's so much of it going on, like the food producers have been hiding it with smaller bags or less amounts in a bigger bag to make it look like it's the same. They're doing all these little tricks to get away with things. But, what have you been seeing, Doug?
Yeah, so basically, Kurt, it's funny because this morning I had an advertisement that came across my phone for Folgers. They've been pushing a new brew. And I was reading through the comments section that people had been posting on it, and somebody was complaining about the cost of the coffee. And I said, look, I used to drink this coffee all the time, but now you've come out and you've shrunk the packaging by 1/3, and you've also increased the price of it by $8. That's it. I'm done. I'm going to find another coffee. Now, raise your hand if you would consider Folgers to be the high end of coffee out there. Yeah, probably not, right? That's the everyday consumer, unless you're buying, the store-bought Kroger Select. So, good luck is all I can say to this, to this individual, if they're going to find a cheaper coffee somewhere else, because this is the reality that we're facing right now, is that, there's different ways in which companies are trying to get you to feel that the pricing hasn't changed as much as the pricing actually has changed. As a matter of fact, I was looking at a chart here that we were taking a look at the pricing increases between 1968 and 2022. Now, if we look at the 12-month ending CPI ending in August of 2022, then the inflation on all items, 8.3%, right? Whether it's soared to it or eased to it. Obviously, as you were saying, Kirk, this is just different ways to try to get people to click on these things and sell you advertising to get you to read the article and hopefully get those advertisers to give money to be seen, right? So always be careful what you're seeing there. But 8.3%. Now, of that, 11.4% was the actual inflation on food items. 23.8% was the inflation on energy. And if we take a look at core inflation, which is all items less food and energy, the core inflation was 6.3%. So clearly a significant impact on the rising costs. And these companies are trying to figure out ways. I mean, unfortunately, there's a psychology there. If I'm a producer of food and goods, and my price has gone up. It normally cost me, cost you $10 to buy my product, and inflation has gone up, compounding. Let's just say it's gone up 30%, overall. Well, then I got to sell this to you for 13. And there's a lot of people who say, well, I'm not buying it for 13. I can't believe you raised the price. So understanding that psychology, consumers will do different types of things. So they'll say, well, we'll keep it at $10. You're okay with $10, but we've got to reduce it by 30% in size to give you 30% less. But at least on your month-to-month budget, when you pay for something, you might not be able to afford 13, but now maybe you will afford the 10 and you'll go buy it. And we've talked in other episodes about some other things that they're doing there. So shrinkflation, skimpflation, these were different things they tried. Now what they're doing is basically, keeping the price the same, but doing more things where they're going to upcharge you. So if you want this, there's an extra cost. If you want this, there's an extra cost. We're seeing that right now with Netflix. They're going to come out with a new tier. And it's interesting because I've seen a lot of people say, well, I don't want to buy Netflix. I'm not going to buy Netflix. I can't believe they're going to start having advertising for Netflix. Well, listen, you gotta understand what's going on here. They're not asking you to start seeing advertising on the tier you're paying. Okay, the tier you're paying, they've already raised it for, whatever it is today. I don't know if it's $14 a month, whatever it moved to. But they're looking at the people that are not willing to pay $14 a month, that they've lost, that they don't have those consumers. Well, what if those people are willing to pay only $9 a month? Oh, well, now that might work in my budget. Okay, well, Netflix has got to get their money somewhere, right? So now they're going to say $9, but with advertising. Are you willing to be patient and watch that advertising, but only have to pay $9? They're not marketing the people paying 14. They're marketing to the tier that is only looking at that bottom dollar. That when they get a menu, they pick the cheapest item on the menu because they're concerned about the impact on their budget. And yes, it's annoying to watch ads, but $9 is not 13, and to the household budget, that matters. And this is, so it's not just food. We're seeing this impact across the board.
Yeah, but I think food is really the one that's important, right? Because, for the last 40 years or 30 years anyway, people haven't, for the most part, had to worry about substitution or things like that. They just said, hey, I'm going to buy whatever I want and I'll just get more money later. I'll put on a credit card or I'll pull it from my home, the value of my home and a home equity line. Like, people did all sorts of stuff because they got away with it because money was growing and there was abundance, and there was always room for expansion, even if you didn't have the money to pay for it. And, if you think back before we get into all this leverage and debt and credit card debt, people actually were thoughtful. They looked at their budget and they said, all right, I've got $100 to spend at the grocery store. What am I going to buy? Am I going to buy steak or am I going to buy a hamburger? Well, I don't have enough to buy steak, so I guess we're going to buy a hamburger, right? Or, whatever you're buying, or back in the day, I remember when I was growing up, it's like, oh, did you buy Coke or did you buy RC Cola, or like, the store generic brand or whatever it was called? It was like, oh, I guess I'm buying the generic brand today. Like, it's still cola. It's just, it wasn't the brand name. And I don't know if there was much of a difference in price, but there, I remember growing up that there were a lot of, non-brand name sodas that you could buy. And maybe it saved you like 50 cents. But the point is it's, there's going to be a lot more of that happening because it has to. Because people have fixed budgets. Income is not rising through the roof that is accounting for inflation at 8%. So despite what our politicians tell us, 8% is a lot. And, I think we've all seen it. It says 8%. I think if anyone's been to the store, they know it's not 8%. They know it's higher than that. So I think it's really important to recognize that food is one of those things that you can't get around, just like gas, putting gas in your car. I mean, unless you don't have a car and you're just taking the bus to work or you're taking a bike. But for most people who drive a car, you can't get around spending for gas or food or house prices, which is what we're going to get into in a little bit right now.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. You mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room.
So getting into the housing inventories, we have charts here of 8 different cities here, and what we're showing is housing inventories of these 8 cities. And we have Boston, Minneapolis, toe to toe, Doug, right here, right at the top. We got New Orleans, Seattle, Chicago, Phoenix, Orlando, and Boise. And what we're seeing, which is pretty obvious here from the charts, is there's a huge spike in inventories, starting this year. And, I think what should be, besides the fact that I think Boston is leading the way with lower inventories, just wanted to point that out there for all of you from Boston. But regardless, we're seeing a huge spike in inventories, and this is a natural reaction to higher rates and lower home prices for people to sell. And people just don't afford. Here's the problem. We talk about this in other shows. The affordability is going down because rates are going up and house prices are still high. So inventories are there because people aren't lowering their prices. But the affordability has dropped a lot, right? So we talked about the 2% to the 7.5%. Well, we're at 6. That's not a far stretch from 7.5, which means we're pretty close to double, right? It doesn't even have to be double. It's up 70%. That's a lot, right? So your affordability, just the affordability of what you were paying for your home at the old price, it's up 70% now. So it's going to cost you 70% more than it did for a house which may have only dropped 5%, right? So this is the problem. House prices move slowly because people don't have to move. Maybe 5% of the people move every year. So over 20 years, maybe there'll be 100% turnover. But the point is there's a disconnect here, and until that is reaching an equilibrium, you're going to have a real problem with home prices. And I think home prices, based on what we're seeing, home prices should be at least 25 to 30% lower. Right now, I think they're going to be a lot lower because interest rates are not going down. They're going to have to keep going up, and mortgage rates are going to climb as well. So I'd be surprised if mortgage rates don't hit 8%. I'd be really shocked. I think if it hits 8%, you're really looking at a 50% drop in real estate. So that's what you should expect. And this doesn't mean you have to go run around with your hair on fire. If you're not selling your house the next 5 years, then it doesn't matter to you, right? If you're going to sell in the next year or two, then you should be worried and you should think about whether you should sell now as opposed to later. But this is a lot like what happened in 2008. Nobody wanted to lower their prices, but nobody was buying because they weren't lowering their prices. And eventually people had to drop their house prices, 40, 50, 60%. And then people came in and bought because that was the real natural level. So I think, I'm not a real estate agent, but just looking at history and looking at these charts, I think this should be a warning sign for anybody, looking to sell their house.
Well, Kirk, and let me just give me a kind of exact example, because you mentioned Minneapolis here, and you can see how incredibly low the inventory got on Minneapolis going into late 2021, early 2022. And it's a point where nobody around the city could find a home at a reasonable price. There's a neighbor just down the street. 2 houses went for sale, both similar size, both similar view. So for most intents and purposes, very comparable. And one of them went on the market in spring this year and sold in the first weekend, 7 offers, and sold for just about 1.1 million. Okay. Now, 3 houses down. This other home waited a little bit, went on the market as we got into the summer, priced it just a little bit less than the one that sold, came in at about $1,080,000. They've already dropped the price down, and now they're looking at close to 900. And I'm watching the activity. There's nobody coming on our street. They had an open house this weekend. Almost nobody showed up, and they just closed it down. So, this is a city. Minneapolis is a great town. The Twin Cities is a great town. Winter is certainly something that doesn't draw people into the city. It's not going to have that tourist destination necessarily of other places. And as they're facing, this supply and demand issue of housing, it was driving housing prices up into ranges that it has never seen, because there was nothing available. And when there's nothing available and interest rates are low, then everybody wants in. But now you've had a significant shift in the price to get every dollar you need in order to purchase this real estate. You've also had a significant shift in the mindset of these banks. They're just not giving it out. The backing's not there from the Fed. They don't like to give money away that doesn't have risk mitigation. And I agree with you, Kirk. I think you're going to see interest rates, because they are tied to a supply and demand for those mortgages. They're going to continue to creep up to a point in which ultimately there's going to be a breaking point on what kind of real estate is available and who's going to have the liquidity to buy it. And those that went up the highest, just like we've seen in the past, are going to be in for some pretty turbulent waters here in the near future.
Yeah, I agree. I think it's a challenge. I'm looking at these charts here, and it doesn't seem reflective of Boston. Maybe Boston, the city, but in the suburbs, there were no houses. You couldn't. Houses were going before they were even hitting the market. And if they hit the market, they were on for a day. So that was back when we had like 2% mortgage rates. Certainly not happening now. Everyone's got a home price, home sale. Can't speak today. A home for sale sign on their lawn, and it seems like everyone saw the top, and then now they're just trying to say, oh well, now I'm going to try to get in, and that's what happens, right? Is you have people who need to sell, and then people who are just kind of waiting around for the opportune time, and now they're trying to everyone's trying to pile in, and it just makes the problem worse, right? It's just it's like yelling fire, and everyone just runs for the door. So yeah, I think we're gonna be talking about home prices a lot, because home prices are what drive the economy in a major way. So if you don't know what's happening in home prices, if you don't know what's happening in the real estate market, then you're going to miss a lot of what is going to affect your portfolio and the economy. So in the interest of time, let's move on here a little bit. I did want to point out this next chart, which is it shows the Fed funds futures prices, which effectively what this is it's pricing in, the market is pricing in what they think is going to happen. So the market is predicting the future of the Fed's funds rate. That is what this is predicting. So in this particular chart, it is pricing in the change between July and the end of the year. So basically the second half of this year. And right now it's showing that there's another 2% Fed funds rate hike between now and the end of the year, which is a lot, right? And you think, well, and I guess this week, although I'm not sure if it'll be here by the time that the episode is released on Wednesday, but we're going to have another Fed funds hike probably this week. People are debating whether it's 75 basis points or 100 basis points. I don't think it really matters. I think we're so far behind the ball. They could do it 2%, and we're still going to be behind. So, people are arguing about nothing, in my opinion. But that being said, rates are going up, and it's a question. I think that if you look at this chart, you can see that people's opinions change over time. most people think, oh, it's just going to go up a little bit more, a little bit more. And as the year goes on, it's still going up more because inflation's not going away the way that they expected it would. Most people thought it was transient. I think, frankly, most people still think it's transient. And they think, oh, well, the Fed is just going to lower rates as soon as the economy goes into recession. And that's not going to happen. I mathematically, it can't happen. The Fed has said it's not going to happen, and people just don't believe them. It's like we've been through 20 years of the Fed bailing us out, and people are just like, oh, they're just saying it again. They're just trying to get our goat. We'll be okay. And I think a lot of people are going to get hurt because they think, oh, everything's going to be fine. And they don't realize what inflation is actually doing to our economy. And so we'll see. So moving on here, I did want to point out the next piece here, which is global inflation, which I think is really the important piece here. So we have two charts here. One is global inflation rates by country, and the next one is global growth rates by GDP by country. So Doug, do you want to talk to these a little bit?
Yeah. So, so what we're seeing here is if you predominantly look at, let's start with the inflation rates. And what was interesting in that, although there are a couple of outliers, for example, Switzerland and France, who have been able to keep their inflation rates fairly low. If you take a look at the where the majority of low inflation is occurring, it's in Asia to most capacity. So topping it out there with low inflation is China, followed by Japan and Taiwan. And again, these are places that are predominantly producing a lot of the products that people use. Of course, Saudi Arabia is on that list too, and we all know where they get a lot of their GDP and production. It's tied to oil and natural resources. And then you start to get into down there the list, you start to see it rapidly rise into 5, 6, 7, 8% range. And now you're starting to see a lot of that occurring in the consumer-driven developed West. So I think that's an interesting pattern that you're seeing there, because we're the ones that are historically going to be the ones purchasing those products. And I think that has a lot to do, again, there's a lot of variables we've talked about, but certainly, as we've talked about the bullwhip effect out there, I mean, it's one thing to produce those raw materials. It's another thing to go out there and get those things manufactured. And then you've got to somehow get it back, which is where I think a lot of the pricing gets tacked on there. Now, if you look at global growth rates, again, we're starting to see a little bit more of a balance there on the global growth rate side of things. I mean, India has been a stellar GDP producer across, compared to the rest of the world. A lot of stuff. They got the population to be able to produce things. A lot of development technology has been moved over there. Interesting enough, with Saudi Arabia near the top, and Ireland, which has just been consistently strong ever since they became, a technology hub for, really on a global scale, one of the biggest technology hubs, and very favorable tax rates for from outside investment there. But you are seeing a little bit more of a strong GDP number there when you start looking at some of those European countries. I mean, down the list though, way down the list, the United States real GDP year to year has fallen from 5.7 in 2021 to only 1.6. So when you start seeing those high inflation rates, Kirk, against a significant drop in GDP, what's that tell you? Does that tell you to be optimistic, or should we be concerned?
Well, I think there's you raised some interesting points there, Doug, and I want to point one of them out, which I think is really, really important to understand. Is we talk about in the show a lot where, the part of inflation. I mean, we talk about how inflation is mostly due to the supply chain. There's another huge aspect of inflation here, which probably don't talk about enough and should talk about more, which is globalization. An enormous part of the inflation impact is through globalization. It's probably one of the biggest factors that impacts inflation. And for the last 30 years or so, we've had this globalization push where in the US, we outsource all of our cheap labor to Asia because at the time it was really cheap, right? You could manufacture a widget here for $5. Over there, you could manufacture it for 10 cents, right? And you could ship it back and it would still be cheaper. right? So that's what everybody did. They had Asia manufacture a lot of their goods, send it back here, and it ended up being cheaper than it could have been had they done it here, which is why a lot of our manufacturing went offshore. People complain, they blame political parties. It had nothing to do with them. It had to do with the fact that it's cheap and companies want to make money. So their job is to make money for their shareholders. So they're going to find the cheapest way to do that. So that caused globalization to take off. It allowed the supply chains to become very efficient. And so what ended up happening was we still had inflation here for the last 30 years. But what we did was we outsourced it to Asia. That's where our inflation went. So people were saying like, oh, why don't we have inflation? Why isn't it going up? We have, but we outsourced it to in Asia. So technically it didn't show up, which is why we didn't really, quote unquote, have inflation. So even though it existed, we just kind of put it somewhere else. We kind of like stuck it under the rug over there, over there in the over there in China and Vietnam and a few other places where we manufacture goods. And so what's happening is now that we're reversing that globalization trend, what's happening is that inflation is coming back onshore, which means that all the inflation that happened that we created is now actually showing up because we're not outsourcing stuff to China anymore. I mean, we are, but we're reversing that trend. And frankly, a lot of the costs for producing goods in China have gone up a lot, so it's not as advantageous. So now we have to find other countries that are cheap. So there's that whole trend. If you look at China, their CPI is 2.5%. Well, if you look at what things were in China, you were looking at 7 to 8% GDP growth consistently. It's not now, right? Look at it now. Where is it now, Doug?
I'm looking at it's down there below the United States. GDP growth for China is 0.4% for 2022 Q2.
Right.
It was one of the few positive ones in 2020, but 2021 it was at 8.1%, now 0.4. So yeah, they're low inflation, but they're and that, of course, this is something to remember. China does not include Hong Kong. That's a separate category. So if we take the Hong Kong portion, that was negative 6.5% in 2020, and it started to recover, did really well in 2021 with 6.4. But now you look at 2022 Q1 and 2022 Q2, negative 3.9% and negative 1.3% in Hong Kong, and that's carved out. Another thing I wanted to note on there is if you take a look at where inflation, go back to the inflation charts. If you take a look at former Eastern Bloc or communist countries like, Venezuela, Poland, Russia, you look at the impact of inflation in those countries. I mean, Russia, 15.1%, Poland, 16.1%, Venezuela, 137%. Okay. So some of these countries that probably were behind on development of certain technologies, which happened behind the wall, they're really struggling with what's going on from an inflation standpoint globally.
Yeah, and for those of you who have not been on the website, I highly recommend going on the website. We have a promotion going on right now for free money. There's when you have 137% inflation rate, that's what we call hyperinflation, right? I don't know where the technical definition of hyperinflation. I'll have to look that up because it doesn't happen all the time. But basically what it means is we have runaway inflation that they can't stop. And it just means that inflation is just going to go higher. And I cannot imagine that they're doing things. They've all of a sudden turned the tide in Venezuela and they're going to start doing things correctly. They're going to go the same route that Zimbabwe went. I mean, right now, I know they've had a few currency changes. So, it's a good example if you really want to understand how hyperinflation works and high inflation. There's some pretty good examples. I mean, Turkey's having their own problems. They have 80%. Argentina is 71%. They're kind of on their way, although Argentina has a long history of high inflation and currency issues. The people in that country are well experienced in managing the government's poor management of their own currency. So the people over there will be fine because they have a lot of experience with it. But Venezuela, Turkey, they're going to have some problems. And look, I think more countries are going to have problems because this is not just a single country. This is globally a problem. And yes, you may have countries like China and Japan that have low inflation. Japan has its own problems. And I think it's just going to lead to more and more inflation that somehow is gonna get brought from under the rug, and now all of a sudden people have to start paying more. At some point that'll be fixed, but it's not going to be fixed before there's a whole lot of pain in advance. So, yeah. So, Doug, as we kind of wrap it up here, final thoughts from you?
Yeah. So one thing I want to go back on early on that you mentioned, and I've got an outdated chart on this, but I think it's important to understand what the government is telling us about inflation. You mentioned it earlier that it's broken up into a lot of different variables. Okay. So if we take a look at the impact of different types of inflation, the real issue here is when you think of what inflation overall is, okay, inflation overall is an overall cost of a lot of different categories that the government puts together and says, hey, look, this is how much everything has gone up together. But the reality is there are the things that we want, which we would just deem discretionary goods, and there's the things that we need, stuff like healthcare, food, clothing, housing, childcare. And for many families, they would consider that to also be college, right? And if we take a look at the line of where actual inflation, has risen, and then we carve out things that have actually gone down in inflation historically, not until recently, but new cars are up until recently, new cars, household furnishing, clothing, cell phone, software, toys, TVs, such a significant decline in those, it actually brings the overall inflation number down. But those aren't things you go out and buy everything. They're not the things that you need. So if you take a look at what real inflation is to the stuff that you have to get to run your household, it's much, much greater than the 8% that they're telling us right now. And I think everybody out there would agree with that and is feeling that much more than, as we say in that article, it's it's tempered down to only 8.3. Okay. Well, it's tempered down to something, but the reality is the inflation on the stuff that you can't afford not to go get is significantly higher than that 8%, even if you try to cut out all of the things you don't need. So I think that's a big concern. And of course, as a segue there, Kirk, talking about college, as you know, we specialize in college planning, helping people find money for college, helping people to get the discounts they need for college, and ultimately get your child into the right fit college academically, financially, and socially. Find out more about how to get that right fit, the impact that that's going to have on your family, especially now as you're seeing these costs of college and everything else go up significantly. What the most important, the easiest way to save money for college is to get into the right college the first time for the right reasons and get out on time. Find out more at ProCollegePlanners.com.
Great. Well, thanks again for coming on the show, Doug.
That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.